Welcome to The Explainer. Today, we are putting on our sell-side equity analyst hats and diving right into a rigorous, fully documented stock valuation of Globalstar. We're going to strictly look at the raw financial metrics and SEC filings to build a comprehensive intrinsic and relative valuation. No hype, no noise, just the pure numbers. Let's get right to work, shall we?
Okay, let's kick things off with an absolutely massive anchor number. Globalstar's current market cap of over $10.4 billion. Wow. Now, when a company carries a $10 billion price tag like that, my immediate job as an analyst is to figure out if the underlying assets, the cash flows, and the growth rates actually support that massive weight. We literally need to strip away all the market sentiment and calculate the absolute intrinsic value of this business.
So, to see if that $10 billion is actually justified, we're going to use what I call a valuation of funnel approach. We'll start with the Globalstar baseline, move through relative and skipped models, dive deep into intrinsic cash flow valuations, check out residual and asset models, and wrap it all up with a final valuation synthesis.
Kicking off Section 1, the Globalstar baseline. Let's start right at the top of that funnel to establish exactly how the market is currently pricing this asset.
And looking at this, Globalstar's history is basically a story of extreme volatility. It's a really sharp contrast of explosive short-term gains going up against a deeply negative 20-year reality. Over the trailing 12 months, the stock delivered a staggering 305% return. In 2021, it returned over 241%, but if we zoom out to the 20-year annualized return, it's actually down nearly 69%. What this tells us is that the stock trades on highly cyclical momentum bursts rather than steady, compounding fundamentals. Now, the juxtaposition here between historical earnings and future projections is just wild. The trailing price-to-earnings ratio, which, remember, compares the current share price to past profits, is deeply negative at minus 543, and that's driven by a trailing net income loss of over $19 million. Yet look at the forward PE. It's modeled at an incredibly optimistic 9.2. Essentially, the market is pricing in an absolute operational miracle over the next 12 months. This massive discrepancy right here is exactly why we need to build rigorous valuation models instead of just taking the market's word for it.
But before we actually build those models, we've got to lay down our rules. Because the source filings lack specific inputs like the weighted average cost of capital, or WACC, and terminal growth rates, we have to declare some standardized, sensible assumptions before we run the math. So, we're setting a terminal growth rate of 2.5%. Why? Just to align with long-term macro GDP growth. For the cost of equity, we'll assume a standard market risk premium of 5.5%. And finally, because the filings don't explicitly list comparable companies, we're making an external assumption here to evaluate them against a peer group of high-growth satellite communications companies.
Moving right along to Section 2, relative and skipped models. Let's see how this builds into our relative peer valuation and talk about the models we intentionally have to skip today.
You see, in a full equity analysis, we want to run as many models as humanly possible. However, we must explicitly skip the dividend discount model for Globalstar. The data shows a 0% compound annual growth rate for dividends. Basically, Globalstar doesn't pay a dividend, so modeling those cash flows is literally impossible. We also have to skip the sum of the parts model. The provided data just lacks the distinct business segment financials we'd need to value separate divisions independently.
So, with those out of the way, we turn to relative valuation. Assuming our peer group of high-growth tech and SATCOM, Globalstar trades at massive, elevated multiples. The price-to-sales ratio is 38.31. That means investors are paying over $38 for every single dollar of sales the company makes. And the enterprise value to EBITDA, which compares the total value of the company to its core cash earnings, sits at an astronomical 102. Even against its own trailing 12-month averages, every single one of these multiples is stretched by 40 to 60%. The market is paying an incredible, sky-high premium relative to the company's current operational output.
All right, now for Section 3, intrinsic cash flow valuations. Getting to the absolute core of this explainer, we're going to strip away that sky-high market sentiment and calculate the absolute intrinsic value based solely on the hard cash this business actually generates.
For our absolute valuation, we begin with the trusty workhorse, the discounted cash flow model. Step 1, we start at the top line with a trailing 12-month revenue of $272.9 million. From there, we bridge down past the negative net income to find the actual unlevered free cash flow, the hard, cold cash the business actually generates, which comes in at a positive $71.2 million. We then forecast these cash flows out 5 to 10 years, attach our 2.5% terminal growth rate, and discount the whole shebang back to today's present value.
Now, in addition to a standard DCF, we also absolutely need to apply the adjusted present value, or APV model. Why? Well, because Globalstar carries a somewhat elevated debt-to-equity ratio of 1.36. You see, when a company carries significant debt, its capital structure can change over time, making a standard WAC calculation a lot less reliable. So the APV model allows us to value the firm's operations as if it were entirely equity financed, and then we separately add back the present value of the tax shields created by that debt.
Which brings us to Section 4, Residual and Asset Models. We're drilling down to the very bottom of our valuation funnel now, looking at the absolute floor of the company's value through residual income and asset-based modeling.
So the residual income model focuses on whether a company is actually generating income above its cost of capital. And right here, we find a fundamental struggle. We are balancing a negative return on equity of minus 5.4% against a barely positive return on invested capital. Because that ROE is deeply negative, this model is essentially telling us that Globalstar is currently destroying book equity value rather than creating it. Its intrinsic valuation is entirely dependent on a future turnaround.
Now, if we look at the balance sheet for a net asset value floor, we want to check the EV to assets ratio. Basically, if Globalstar were to liquidate tomorrow, what are its raw assets actually worth? Well, currently, Globalstar trades at an enterprise value to assets ratio of 4.50. This means the market prices the company aggressively at 4.5 times above its basic recorded asset value. There is very little downside protection here if the growth story fails to materialize. You are paying entirely for future potential, not existing hard assets.
Okay, Section 5, Final Valuation Synthesis. The crucial point here is bringing all these disjointed metrics, intrinsic models, and baseline facts together into one clear valuation truth. Let's look at the final synthesis. Summarizing our fundamental findings across the board, the DCF and intrinsic free cash flow models output a fair value price for Globalstar of exactly $14.72 per share. Now, when we compare that intrinsic fair value to the last closing price of $81.48, wow. It reveals a terrifying negative 453.72% margin of safety. From a strict, traditional sell-side valuation perspective, based purely on trailing and projected cash flows, the stock is massively overvalued.
Which leaves us with the ultimate question as we wrap up this explainer. With the hard math pointing to a $14 fair value, is the market seeing an incredible, visionary future in satellite communications that the historical filings simply don't show yet? Or is this $10 billion explosive premium just a mathematical trap waiting to spring on momentum investors? Thank you so much for joining me on this deep dive, and I will leave you to ponder that exact question.